Hello, everybody. J Rock here, and I want to thank you for joining. I am going to reveal my moving average strategy to you in relation to the web analyzer. And here I have a couple of students with me. I have Alina Gray and I have Kenny Britt, both from Utah, that I have been mentoring for this week and showing them how to use the moving average strategy. So they are going to play the student in this situation when I go through what the strategy is about and I show you. Then they're going to ask some questions that were probably on your mind as well. So without further ado, let's go ahead and look at this strategy. I'm going to share my screen and we will get right to it. So what you're seeing right now is a chart of Euro USD, and this is one of the most traded, most liquid pairs. So it is what I'm going to use for my example. And you are currently looking at a naked chart, which means there are no indicators on it, just candles and one indicator down at the bottom called the RSI, or the Relative Strength Index. And the red up here is your overbought territory, which means it's time for a sell. Your green line, the 30 down on the bottom, is your oversold territory, which means it's getting close to a buy. So that's why I put the green line. And then the white line in the middle is your relative strength indicator that will tell you when it gets into that area that it is close to being time for a reversal. All in all, when you utilize my strategy with the web analyzer that creates signals based on an algorithm that releases volume signals based on buyers and sellers coming into the market or into a certain pair that we are unable to see, but it is a part of the algorithms of web analyzer, friend, it really gives you a much greater or higher probability trade for you to profit based on the moving averages that I'm going to show you. When you combine them together, you couple them one together, then you will actually be in a better position to profit almost immediately. Now, I do get a question that's asked, how come you don't use the MACD or the stochastic indicators? Those are basically beginner indicators, and they are called lagging indicators. So it tells you what has already taken place when you look at something. You are actually very late to the party, and you miss quite a bit of the move because you're waiting on crossovers. With the moving average, you see almost immediately when the reversal is taking place, and you get a better chance to get into it at a much better price than waiting for an extended period of time for the MACD or stochastic crossover. So, as I said right here, you see the candles, and I'm going to widen the chart out, give you a little bit better view. Let's see here. Well, don't know why that did that. Let's see if I can get this to, there we go. Move this over here. So I am currently looking at the 5-minute chart, and I'm actually going to go to the day chart. Now, one of the first things that I tell people to do is whenever you get a signal or you're looking at a pair, you want to analyze from the month time frame to the week to the day, and then you go down into the 4-hour, 1-hour, 30-minute, 15-minute. So you are starting from the longest time frame, because the longer time frames will determine the direction that the pair is going or expected to go. The lower time frames will determine your entry or exit. So the day, week, and month will tell you what direction the pair is going, and then the 5-minute, 15, 30, 1-hour, and 4-hour will tell you what your best entry is going to be. The lower time frames will give you a tighter entry place to profit much quicker. So if I'm looking at the daily chart, we're just looking at the Euro USD, and I want to start analyzing what it's doing. Well, currently we see we have a bottom way down here. This was in December, and it started putting in higher lows, and this was a high point. It put in a higher high, and then a higher low here, a higher high, higher low, higher high. So we started getting in a channel trend that was trending upwards. If I were to draw a trend line going across, then you would be able to see that you have a channel trending upwards that is taking place in the Euro USD. Then we went way up here and we started consolidating sideways, finding support, fell through a little bit. And if we were to scroll back in time, this price point might have been a support level for a time in the past, a price support level. Then we went forward and we broke out and continued to go up. Well, then we put in what's called a double top right here, and we are pulling back. So the expectancy for this right now is to continue to go down, the Euro USD, and this is a current support level. Now, if you are new to trading, the most basic tools that you would use are support and resistance, lines going horizontally across your screen. You see my crosshairs that I can put that on the chart and see it right away, lines of support or resistance. You can also draw in trend lines where they are going diagonally to help you identify a certain trend. You would come over here and select one of the lines on the chart, and you can draw yourself a trend line to make yourself a channel so that you can see exactly what's happening. But with moving averages, you will be able to see that much clearer. So I'm going to go ahead and start by putting out one of the longer time frame moving averages. And if I load that one up, you can start to see where your lines of support or resistance moving averages will help determine that almost to a T. So if I scroll back in time, you can see this moving average that is like the 100 simple moving average, where it will almost connect bottoms and provide support. So it gives you an idea of where a pair is going to potentially reverse. Now I'm going to add another one, and this one will be like my 100 period moving average. I'm sorry, my 200 period moving average. And it is more of a battle line. And so it also provides, like right here in this time frame, that it's not an exact science and it's not always going to be perfect, but it provides a very close probability of that being a reversal area, a support or resistance. Now the 200, you say, well, what is a moving average? Well, a moving average is simply taking that number that the moving average represents, taking the number of candles and adding all of their closing price together and dividing by that number. So if I have a 200 moving average, I will take the last 200 candles, take the closing price of that candle, add them all together, divide by 200, and it gives me an average. And I put a dot right under or above wherever that candle is at. It gives me a price, and I put the dot. When the next candle forms, then I will remove the first candle and then add the last candle, and then it gives me another dot. And then over time, you connect all those dots to form a line. So the 200 moving average would take 200 candles. The 100 would take the last 100 candles. The 50 would take the last 50 candles, and so on and so forth. Moving averages are basically the average of the closing price of the last number of candles based on that moving average number. That's all it is. And traders will move the market based on lines of support and resistance. What are they using to help them determine lines of support and resistance? Moving averages. As I told you, the most basic form of support and resistance are horizontal lines and trend lines. You get a little more technical, you want to be a little bit more of a professional trader, you will learn to use these moving averages. The colors that I have are based on what I set for my own preference, and you can use whatever colors you want, but I like to use certain colors from lighter to dark, and I'm going from the higher number down to the low number. The red line, you can consider that your danger zone. That is your last line of defense, so to speak, support or resistance. When it rides above that, it is in an uptrend. When it gets below it, it's going to be in a downtrend. Here it popped up and held it right here, and then we started a nice uptrend, and it got on top of the purple line here, and it held that purple line. So you wouldn't necessarily release or close that position until you see a breakdown coming. Now you have the ability to turn these indicators, each of these moving averages, on or off to help you see a little bit more clear. Because I do use quite a bit, I'm going to turn another one on, and that is the Bollinger Band that has the 20 period. So let's turn that on. And you will see the Bollinger Band has the wavy green lines that are outside of the pair. It's almost like a road that you are traveling in. Well, let me expand that so you can get a better view. And the white line in the middle is your 20-period moving average, 20-period simple moving average. And I say period because it depends on the time frame that you're in, whether you're on the 5-minute chart, the 30-minute chart, or the 1-day chart. If it's the white line is the 20 on the day chart, it's the 20-day moving average. If you're on the 5-minute chart, it's the 25-minute period moving average. So here, takes the last 20 candles and it puts a dot. Now, when we get on top of the 20, which is your Bollinger Band midline, we will tend to trade in a trend or in a channel above that 20-period moving average. So it's kind of like staying on the left side of the road or the right side of the road. What are Bollinger Bands? Bollinger Bands are these wavy lines outside, and they are basically a measure of price action and volatility taking place, and it causes the lines to make waves as it goes along due to the volatility of the pair and the price movement. Now, when it overruns your Bollinger Band, it will generally pull back in. So that is an extended move of your Bollinger. Currently, I have it set to a standard deviation of 3. Sometimes it will be a standard deviation of 2 that will squeeze it in a little bit more. But I have it set to 3, so it has a very clean look to it. And like in this situation, you have sideways trading. It's called consolidation. So you're not necessarily going to do very well making money because you can't see a trend developing. This right here is a very clear trend that is taking place. And when it gets pretty high up, you will cross-reference with your RSI and say, it's way up here in the overbought territory, the 70 line and above. So the red signifies that it is potentially ready for a reversal. But it doesn't always mean that way. You have to take into consideration your other time frames and your signals, because you see it can get up and ride above the 70 line and stay in overbought territory for an extended period of time if there's a lot of buying pressure. Now, I'm going to add another one, so I'm going to widen this out, and I am going to add what I call the 10, and it's actually the EMA 8 on here. And you will see when you have a very strong trending move, it will hold the 10. So you say, well, what keeps it suspended in the air? Why is it holding there? Well, the moving averages. It's riding the moving averages. So that is why it stays extended periods of time moving in an upward fashion. So if you look closely, move that over, and you can see that's what's causing it to stay up there. It's riding and holding that 10 period, or my orange line, and then when it breaks down and gets under it, it'll stay under it and hold these other moving averages and determine if it's going to bounce back up or come down. Okay, the last moving average that I have is the 5-period moving average. That's going to be a light blue line that's going to pop up in here. And actually, that one went way down there, so I need to change that. Sorry about that. I don't know why I did that down there, but here we go. It is the 5-period that takes the last 5 candles. Now, I call the 5 and the 10 the minor moving averages, and the 20 and the 50 are your intermediate moving averages, and then the 100 and the 200 are your major moving averages. They move much slower because they have much more of the candle closing price to take into consideration to give you a smoother line. Whereas the 5 and the 10, they will ride more closely with the candles. And that is how you're going to determine when a signal is given, where on the chart are you actually going to get in. You don't just jump in when that signal comes. You have to use other indicators, because the signal is a black box program or a creation that is determined by algorithms that are set. If it was perfect and called it perfectly every time, we'd all be trillionaires. The fact of the matter is, it is a tool that was created to be able to help you make more sound trades or higher probability trades for you to get into profit quicker and capture some pips, $20, $30, or $50 at a time without having too much of a drawdown. So you have to look at other indicators to be able to help you. Now, I use the 30 or the 1 hour, the 30-minute or the 1 hour time frame to help me determine what I'm going to get into. So let's go ahead and look. The Euro USD, I'm going to go to the longer time frame. I'm going to analyze this for you so that you can see what I look at when I analyze a pair. And I'm going to squeeze that in, give you multiple years over time, and that way you can get a better idea of what is taking place. All right, so this is over the last roughly 20 years. We see that it has been putting in lower highs and lower lows right here, and it formed a support level, okay, right at that level right there. Then it came up and put in another lower high from the previous high, and then the bottom fell out, came way down here. I'm going to expand that area so that you can get a better look at that. All right, let's see, shift. Sorry about that, it keeps popping that up there. Okay, so with this, over the last few years, you can see when it came down, it put in a bottom, bounced, put in a bottom, and then it put in another bottom. That is called a triple bottom. When you have a triple bottom, the statistics say that you have an 86% chance of a reversal compared to a double bottom where you have only a 55 to 60% chance of a reversal. But a triple bottom is a very sound technical trading indicator or setup. Then we got on top of the moving averages and we started riding, and this is the month chart. So you see, once it got up here, popped above these moving averages, and it got on top of the 5, which is your light blue line, and it started going up, broke through the 50, traded sideways with a little pullback right here, almost to the 10, and then it got back up and it started trending upward again. Well, what would cause this to stop in midair and start to come back? Well, it could be a price area that caused it to stop and come back down, or it could be a moving average. Let's see if I can get this moving average to cooperate, but it's not cooperating. The 100 moving average, 100 period, it's not on this setup, but it comes across right here. So if I were to change, I'll just show you. I'm going to make a change with this one and show you what it looks like so that you can see temporarily. So the 100 period moving average, and based on TradingView, we've had to utilize indicators in a different manner, but they still work the same. So I'm using the simple moving average. I converted the 5 to the 100, and you see how the 100 comes right across the top. Well, the Euro USD stopped right here, went all the way up and hit the 100. Then it came back down and it started the next month and ran up again and hit the 100, and then it started dropping. That is double resistance. So it's probably going to come all the way back down here to the 10 or maybe the 5, which is going to be in the 119, 118 range. It could come all the way back down here to support, which is around 115 or 116, before turning around and powering back through the 100. So that is the look of moving averages on the monthly time frame. Let's look at the weekly time frame. All right, on the weekly time frame, just waiting for that to load up. And you can also see the weekly time frame has been very strong, uptrending, sideways consolidation for multiple weeks, and then we pushed up to new highs. Now what are we doing? We are sideways consolidating again with a very big down week that is right at support on the weekly, which is the 10 period moving average on the weekly. So I believe this is going to break down further and fall on down. But you have to take the indicators, the moving average, and say, well, is it going to hold that moving average? If it does, then we have to stay in. Sometimes it will just penetrate down through the moving average, but then come up and close above it and then push back up. So it's kind of a wait and see on the longer time frames exactly of what EU is going to do. You will take into consideration your moving averages to determine that. Now, let's look at the daily. And we were on this earlier. and we saw that we had put in a double top right there, and we broke down. So here we rode, and actually let me change the moving average right here back to the 5, and you will be able to see where the 5 period is. Right, we rode the 5 and the 10 all the way up, and then we broke down below it. We had a little bit of a downtrend to the 50, and then we held that 50, the purple line, and started jumping back up. We rode again, pushed way up, and we formed a double top. You see my grid line, my crosshair right here on the top here and the top over here. That is a double top. We went above it right here just a little bit on that candle that day, and then boom, we broke down and started tumbling. And I've called for a sell on this based on the moving averages, and the web analyzer also put out signals for a sell, but it normally gives you signals for smaller time frames. So I saw that it was going to continue to fall, and I believe that it will continue to fall. It has a little bit of support right here around 122.50, that it may bounce a little bit and then trade sideways and come on down further, because the minor moving averages, your 5 and 10, are now above the price candles. So it is in a temporary downtrend, and it just depends on if it will hold those candles, those moving averages, and come on down further. Okay, we are going to look at the 4-hour time frame. So I'm basically going in a progression from the higher time frames down to the lower to paint a picture of what I'm looking at to give me an idea of where I'm going to enter or exit a trade. So here we're in the 4-hour time frame. We had a drop off right here, and it held the 20, which is your Bollinger Band midline, and then boom, it took off. Monster candle, and then it trended upwards for the next several 4-hour candles, traded sideways, popped again. That is your double top that took place compared to what we saw over here. There's your double top on the 4-hour time frame. It is almost like a triple top. 1, 2, 3. And this went a little bit higher. So we call this, when it goes up above, this could be called a bull trap, because it traps people into thinking that it's going to the moon. It's going to take off. Well, no, that's a triple top. You want to be very careful and let it confirm by the next 2 or 3 candles before you just jump in. So here it ran up, and I was doing sells on this at this point, saying it's going to come back down because it's too high. And I utilized this by looking at the monthly time frame, with the 100 period that I showed you earlier was a strong resistance. So when it came up and it kissed that 100, then it tumbled, boom, all the way down. And here we are, way down here at 122.70 currently from 125.50. So we've had almost a 300-point drop off in the last couple of days, since Friday, I believe. And today is Wednesday. So the 4-hour time frame shows you how when it gets on top of the moving averages, it's trending up. And you cannot predict news. So whenever you see a big drop like this, it was probably something that caused it, which came out of the political, social, or economic arena. News came out and it caused it to drop, but then the buying pressure quickly came back in and ran it up. So you cannot predict news. You want to use what I call stop losses, which you should know if you're going to get into trading. That should be one of the first things you do. A lot of times people will put a stop loss 30 points below, and that's a standard stop loss area. But you have market makers and manipulators that will have a lot of money. They will move a currency, if they have the ability to, with a lot of money, and do what's called stop hunting. So they'll drop and take out your stop loss, or they'll run it up and take your sell stop loss out, and then turn around and go back the other way. It's happened to me. I'm sure it's going to happen to you if it hasn't already. You have your stop loss, it comes up, hits it, takes you out, and then goes right back down. And if you would have had your stop loss just a little bit more wiggle room, a little bit higher, you wouldn't have been stopped out. But I've had it where it hit that stop loss and then go the other way, where I've been hundreds of dollars in profit. But that's the nature of the trading game. You've got to know how to trade and play with them as they play their game. So as you see, it ran up, and then when it got under the moving averages, we are holding under those moving averages. When it holds under the 5 or the 10, it is in a very strong downtrend. When it holds above the 5 and the 10, it is in a very strong uptrend. That is the simplest way to look at it, by widening it out. Now here, I also saw the RSI was way in over bought territory in conjunction with this. So I knew that was a bull trap when it just bounced up like that, pushed through the ceiling or the resistance area, and that it was going to come back down. So I was putting in sells at 125.44, right in that area. Timed it almost perfectly. Now I will drop down one more to the 1 hour time frame, which is the time frame I like to trade and get my confirmations on, as well as the 30-minute. So if I squeeze this in, you see how we've been in a downtrend since the peak. We've been under all these moving averages. There's your 50. We had the 100 to navigate. That's when we hit a period of heavy consolidation. Here was your 200. So it came down to there, bounced up into the 100, and boom, it started falling off, getting under these moving averages again, more consolidation, and then it dropped off hard again. You're looking at your RSI as well. And as I told you, if I haven't already, the 50 level in the RSI, which is the midline right about there, when it is trending upwards, it will stay above the midline, above the 50, with only one major penetration down through it when you had news like this right here that caused it to plummet and then pick right back up. But you see where it almost hit the 30, which is the oversold area, and then did a dead cat bounce where it just shot straight up, like dropping off a building. Boom, hit the ground and bounced up in the air. Well, if it's in a strong uptrend, the RSI will channel above the 50 line. If it's in a strong downtrend, guess what? The RSI will channel below the 50 line, between the oversold line, the 30, and your 50. That's where it's been channeling as we're in a strong downtrend. With an occasional pop almost up, we may have a big pop at some point where it'll come all the way up to 70. Don't know where that'll be. You don't want to be greedy and try to trade it all the way out. As I say, you move your stop loss as you go along. And then we're going to go on down to the 30-minute time frame. When you get an indicator, and I'm waiting on an indicator to pop up to give us a signal, and we will analyze it as quick as possible and decide if we're going to get into a trade. So here's the 30-minute time frame. As well, you see the RSI, how it's gotten into a channel under the 50 midline down here. So it's channeling. That's telling me that it's going to continue down. When you have it getting close here or coming further down, you know that you can do a little reversal. But you do not want to buy a downtrending pair, just like you don't want to sell an uptrending pair. You want to be on the side of the trend. They say the trend is your friend. So you would want to wait for the bump up or the lower high to get into another sell for it to keep going down. Similarly, when it's going up, you wait for the pullback to make the higher low. Then you get in there and you run it up, and then you can exit, and then you get back in at the higher low, or you just ride it up until you think that it's exhausted itself, and then you would get out. Dropping down one more, I'm going to go to the 15-minute time frame, and I'm just doing a progression through all the time frames, and then we're going to go ahead and get into some questions. So here is the 15-minute time frame. And when you get into the lower time frames, they tighten up your entry or your exit because the RSI is a little bit tighter, and you can see the peaks and valleys on the trend. Now, sometimes when it gets in a consolidation range, you don't have a whole lot of pips to capture in the consolidation phase between the peaks and the valleys, so you just have to let it ride itself out. Here we have a bottom at 123.12, 1.2312, and a top at 1.2334. So that's about 20 pips. You're not going to capture a whole lot in this, so you might as well just hop in and let it ride itself all the way down until it gets a break. And here we had holding that support level right there as we see the bottoms, and then it bounced up into the 200 on the 15-minute time frame before tumbling and then putting in lower lows. It broke down below that line of support right there, that candle finally when it did pop. Okay, last time frame I'll show you is the 5-minute time frame. Same thing. You look at it and determine. Actually, we just got a signal 54 seconds ago. I'm going to click on this. This is Euro JPY, and on my strategy it gives you the 30-minute time frame. So I clicked on this, and I'm going to look at what we've got going on here. So it just happened a minute ago. No need to rush. Take your time. We're going to look at it. I know this will pop up and show you the pairs and tell you what the news is, and you can close that to get yourself a bigger chart. So I'm going to close that right there. And as I said, you want to look at the monthly time frame, and you want to drop down, progression down, and see what's going on. So the monthly time frame, on Euro JPY, it's telling me that we are starting to curve on down. So we bounced up, hit a double top here, and then came on down. Then we bounced up. And it looks like where this support level was right here, if I drag across, you see where we've hit the peak. So if you look back over on the support that I just showed you, we're at that peak. So it's saying it's going to come down on the month like we're getting ready to roll on down. Well, Web Analyzer gave us a buy signal for a smaller time frame. So I know ultimately this is going to probably roll on down. Let's go ahead and look at the week view. And we will see on the week view when we get closer that we have dropped down under the moving averages, and it is potentially a bounce point. This week it has bounced up a little bit, almost into that moving average right there, but we have pulled back. So we could drop further or we could push up. We just have to look at the other time frames. Go to the day. And now, as I said, Web Analyzer is giving you signals based on algorithms, and you want to make sure you take everything into consideration. So here we have the day, and you have your higher lows and your higher highs until we get to this point. Then it broke down below all your moving averages, got below the 100 going across here. It's between the 5 and the lower Bollinger. So you saw it drop below the Bollinger. It jumped up, got into that channel, and started trending down. Now we're trending sideways. Is it going to fall off, or is it going to jump up? Well, here we have support at 131.15. We're at 132.17, about 100 points away. To me, I would say that the longer time frames are saying this is going to fall. The euro is going to fall against the Japanese yen. Let's go to the 4-hour chart. And squeeze that in here a little bit. So we are on the 4-hour chart. We have a bottom that's set in right there. We are very close to a possible bounce or a breakdown through that bottom. That's where you have to take into consideration what the signal is giving you and determine whether it's an accurate move for you to take, because sometimes it can give a signal that is not ready yet. And when you learn the moving average strategies, friend, it will help you immensely. So I'm going to drop down to the 1-hour time frame. We'll get into the lower time frames and see, can we capture some pips on the bounce? Or the other benefit is this: it's giving you a signal, and you go look at it and say, wow, it's bouncing because of volume, but it really looks like it's going to go the other way. So the Web Analyzer gave you a phenomenal setup for the actual opposite way. You just have to sit there and wait it out. So it may pop up on volume spike, but you might want to get into the reverse for it to go the other way, because you see that it is very near breaking down or going the other way. So here the 1 hour came down below the red line, your battle line, and it is now trending down below. That one candle has popped up, so we may get the next candle on the hour. That takes 25 minutes more before it forms, and then boom, it may fall on down to this support level or continue. Now let's go down to the 30-minute. All right, so here's where it called a 30-minute time frame. It bounced off of this level of support right here and has been bumping up, and it got above my 5 period. However, it could channel into the 10 and then drop, or it could push all the way back up here to 132.40, which is about 20 pips potentially on the 30-minute time frame. And if you go across where that moving average is, you go all the way across, you start to see lines of support or resistance where these candles were actually bumping into that ceiling. So that was old resistance. When it broke through here, it became support. Then we broke down through it here, a little bit of a bear trap when it got under and it ran up. Then it came and broke down through it again. Let's go to the 15-minute time frame. Okay, same thing here. If I look at these candles coming down, we broke down through the moving averages. We channeled between the 5 and the Bollinger, bounced into the 10, came all the way down, bounced up, trading sideways. Now we're catching up on the 5, but we have overhead resistance at the 10. So it could hold the 5 and jump up to the 10 and then come down. I'm sorry, the 20, the white line, Bollinger midline, and then come on down. Or it could tumble from here, still finding resistance at that 10 moving average. So it doesn't seem like it's totally ready for a move to the upside yet. We still got overhead resistance. So it is a good signal for me to analyze and say, it's possibly going to continue on down. We don't have a whole lot of upside. The signal that it gave was for a quick 10, 15, 20 pips, and it is going to be ready to tumble on down and go the opposite way. Let's go to the 5 minute, and that's where I will end my analysis of Euro Japan, EJ. All right, so on the 5 minute time frame, it seems like it is still in a downtrend, and it is falling off right here. So here we bounced, came on down, we bounced, and then it looks like we're going to trend on down. It could put in a double bottom right here on the Bollinger, not quite at the Bollinger. And here's another tip I'll give you. When you're looking at the Bollinger Bands, you can create double buying opportunity or a double sell if it has the first bottom penetrates below the Bollinger and the second bottom stays above it. That is a double bottom buy. Same thing on the top. If you come up and you hit a peak and it penetrates through the Bollinger, comes down, and then the subsequent peak does not penetrate through the Bollinger Band, that is a double top sell, and you can expect it to come on down. So it is breaking down a little bit right here. Still not ready. It could create a buying opportunity if it comes and holds and then starts to go back up. We could come all the way up here to these moving averages, which I said 132.40. We're at 132.11. So now we're at about 30 pip potential for the reversal if it does confirm a move to the upside. Do you guys have any questions for me as I've been going along?
Yes.
Okay.
So how do you think this strategy ranks in relation to the other web analyzer strategies?
How do I think this moving average strategy ranks in compared to other web analyzer strategies? I have not looked at the other web analyzer strategies, so I don't know. I'm not familiar with them. I just know that this strategy, I've been trading for 20 years. This is one of the strategies that I learned taking professional trading courses. It's what professionals use, and they also couple it with a couple of the indicators like the Fibonacci retracement tool. Some use Pitchfork, but the moving averages and RSI work very well for me to capture a decent amount of pips. And I should be asking you that question since you've been here for a couple of days learning from me. Have you seen the moving average strategy work for you?
Like a charm. So,
like a charm. Have you profited from the web analyzer and the moving average strategy?
Oh, absolutely.
Very good. So I believe that it is a very powerful strategy that many people will profit from as they learn to use it. As I said, you can take off some of these indicators to help clear it up for you. But when you do, it takes away your ability to see support and resistance levels. So you want to use all of the indicators that I have on there so that it helps you get an idea of where a potential reversal is going to take place. Kenny, do you have a question?
Yeah. Do you have any tips on where to set a take profit or even a stop loss?
That is a great question. Tips on where to set a take profit or stop loss. A lot of times when you're channeling in a trend, then you will get in on a point of reversal, which would be a higher low for an uptrending. So you would put your stop loss just below the previous low. Some people will do a number like 30 pips or 40 pips. Sometimes I'll do 50 pips. I get a little more wiggle room. And as it runs up, so it goes to the next level, I will bring my stop loss up to my point of entry. And if it runs up even further, I will bring my stop loss up to the next swing low or right below it. Then if it gets really far and takes off and runs 30 or 40 or 50 pips or even 70 pips, I will just take profit, close the trade, and wait, because it's not very often that a trade will run 150 points. A lot of times it's going to run 50 or 60, and then what does it do? It comes right back down, or it goes right back the other way. I have left so much money on the table by holding long for it to continue in that breakout, because 9 times out of 10, what I found out, when it runs up, it comes right back down to that point. Or when it drops, it comes right back up almost to that point or to a Fibonacci retracement level, the 61.8 or even the 100% retracement. So I've learned the best strategy, especially with Forex trading, is to, when it runs, you take profit and get out, because it's almost always going to come right back down. It may not come all the way back down. It'll put in a higher low, and then it will go up further and come down again, put in another higher low, go up further, just like it's doing here. A low, a higher low, a higher low, a higher low consolidation, then boom, it runs off again, breaks above that ceiling. Same thing with stop losses. You just move them up, or you will risk giving up more profit than you want to.
So another question that I have is, what is the best session to trade with your strategy?
All sessions are good to trade with a moving average strategy. London is obviously the most volatile and liquid session because the majority of people are in that region. They're awake, and a higher population percentage trade. And even in America, South America, this side of the world, we wake up at 2 in the morning, 3 in the morning to trade the London session and to profit. And then the New York session opens 8 a.m. Eastern, and it crosses over for about an hour with the London session. And we can profit by using the moving strategies as long as a pair is moving. If you're in sideways consolidation, a pair is not moving, so you're not really going to make a lot of money in this area. You need to wait for a breakout. Don't just get into a trade just because you think that you want to be in a trade. You need to be making money. No, you need to be patient, otherwise you'll lose money. Wait for a developed trend, or you see it getting in under the moving averages or getting above the moving averages, and then you can ride it to decent profits.
In my experience, there's some currency pairs that seem to move a little bit faster than others. So, like, what are your favorite pairs to trade using this strategy?
Very good question. My favorite pairs are the Euro USD, the most liquid pairs I pointed out, and then the British Pound, GBP, JPY, the British Pound against the Japanese Yen. Now, both of those are very strong movers. You need a stomach that can handle that. Otherwise, you need to keep some Rolaids next to your phone or your computer, whatever you are using to trade with. I personally have never traded with anything but my phone since I started trading Forex. I've made thousands of dollars doing it from my phone. Anybody can do it. Very easy. But the most profitable pairs that I trade for are, as I said, EU and GJ. But you want to make sure that you don't over leverage. You don't put more on the line. I recommend 0.01, 0.02. You can make money with those lot sizes, getting in with a lower lot size because they move very quickly, and you don't want to get caught in the reversal going the other way.
So would you recommend trading crypto with your strategy?
Crypto can definitely work with the moving average strategy. However, I highly caution anybody that's new from trading crypto because, number one, it is not liquid, very illiquid, which means there's not a lot of traders that are trading it. That's why you have high spreads. With Euro USD, the spread is 1.3 points. With a cryptocurrency, you can have 30, 50, or even 300 point spread like with Bitcoin. That puts you at a major disadvantage. I know it moves quickly, but you have to overcome that spread to get into profit. So it is illiquid. You have high spreads. And number two, it is very volatile and easily manipulated by pump and dump groups or people that have a lot of money to be able to manipulate it because they can swing it very far in one direction or the other, 1,000 points at a time. And if you're not protected or you got too much on the line, it'll wipe you out completely. So yes, the moving average strategy does work to a degree, but sometimes because crypto can be so manipulated, it doesn't always follow technical analysis. And I would wait a little bit further down the line when more traders start coming in to trade crypto, then you'll get the spreads that will tighten up and create a better trading environment. But if you learn the moving average strategy, you'll be ready to trade crypto when that time comes.
Awesome. And do you use dollar cost averaging with this strategy? And if you do, where do you put your other stop losses when you're doubling down?
Okay, very good question. I actually do use a strategy and I teach it. It's called dollar cost averaging, and a term that I created, double down. It's actually a Vegas term that they use. It's basically when you get into a position, let's say you think that it's going to fall here. So you put in a sell position at this point, and then it ends up going against you. You will double down at 20 points away from you. you really feel strongly that it is going to break down at some point. It just didn't do it right then. It ran against you a little bit further. So you make your first entry, 20 points away that it goes against you, you make your second entry. So let's say we did a 0.01 lot here, you double down, you did a 0.02 lot, 20 points. Then you put your stop loss 30 points from that second entry. So you're really doing 50 points of a stop loss from your first entry and 30 from your second, and you've doubled down. Then if it goes against you again, sometimes what I'll do is I'll make a third entry, a double down again. So I have the first entry, a 0.01, the second entry, 20 points away, 0.02. The third entry, 0.04. I double down the second entry, and I only have my stop loss 10 points from that third entry, so I have a tight stop loss. The reason I do this is if the pair ran 100 points or more, and you really feel or think based on technical analysis that it is going to have a reversal, then you get in. It's very rare that it will run another 70, 80 points, or very rare to run another 50 points. So I will enter, then 20 points later I double down, and then another 20 points I double down again, and I have a stop loss real tight after the third. So I'm willing to give up some profit, or willing to give up a little bit, because I feel strongly that the pair is going to go in my direction. It just wasn't ready yet. I got a little bit early and I didn't wait for the confirmation, or it did confirm that it was going that way, but then popped up and news caused it to run the opposite direction. So you have your last entry, you have a stop loss very tight on that last entry, and that's how I do that.
Okay. And then what is something not to do with your strategy?
Something that you don't want to do with the strategy, well, I would say you don't want to buy and hold for long periods of time on the moving average, thinking that it's going to go to the moon or it's going to zero. Well, right now you see Euro JPY is dropping off the map. Well, I did say based on the longer time frames it was going to drop off. A volume spike caused the algorithm to spit out a signal. But when you learn how to trade, you will recognize, say, I think it's going to go the other way. So I would have been waiting to enter sells, and I would have probably entered a sell. The web analyzer actually gave me a great setup to go the other way with it, because I have understanding of the charts, and you should be able to learn that as well. And you see it dropped way off, and it's given about 40 pips on the drop off, and it is still going. So I'd be looking to get into an entry, a buy, because look where the RSI is, way down here. I would look at my next time frame, 15-minute, and then I would say, hey, this looks great. I'm going to go ahead and buy this pair for the bounce here. So I actually use the web analyzer signal to create a move to the other side. And buy and hold, like I said, is not one of those that you want to do on the moving average strategy. You want to wait it out. Okay. You want to get out once you have a very strong move in your favor. Also, you don't want to over leverage, because that will blow your account anyway. That's just a standard trading principle. Anyway, don't over leverage.
Cool. I just have one last question.
Okay.
It seems like this strategy could be used off of the web analyzer. So why would you recommend it be best used with web analyzer?
That's a very good question. Absolutely. You can use it off of the web analyzer, but with the web analyzer giving us signals that we don't have access to based on algorithms that were created by the founder, Stephen Hooley. He put together a program that taps into other programs that we don't have access to based on volume, buyers or sellers coming into the market in a very strong move. So, you can utilize the strategy based on the signals that it spits out, and it is a very vital or invaluable tool, in my opinion. And I think it is a game changer based on using the moving average strategy as well. When you get a signal, you can analyze a chart based on that signal, and it will tighten up your profit so that you can get into profit much sooner and not have to look at 15 different indicators before you make a trade. All you're doing is looking at different time frames, checking your RSI on the time frames, seeing where your price is in the moving averages, and then you make an entry or an exit. And that's it.
So I also have one last question.
Yes.
So for all those new people out there, would you say they would feel confident using your strategy right off the bat?
Absolutely. This strategy can be used by every trader level there is, and it is definitely very useful for beginners. They just have to learn how to recognize the chart. I hope I've made it clear today. As you've been here learning and reading and seeing how I do it, have you learned the moving average strategy?
Definitely.
And it does work for you?
Yeah.
All right.
But I'm learning from the best.
Well, thank you. I do believe that it is a very easy to learn strategy. I know there's a lot of lines in here, but the lines all have a very specific meaning, and they will help you to be profitable in your trades rather than hurt you, because you know how to use them to profit from every trade. And with that, I'm going to say thank you for watching. I hope that you really learned a lot from this, and you will be able to go forth and apply this strategy to the trades that take place, and you will be able to start making money. Thank you, guys. Take care.